Shane, how's it going?
It's going, man. I'm just busy these days. So we'll try and keep this one to a shorter version, maybe 30 minutes or so. There's a lot to talk about, but we don't have time to cover it all. So we'll have to hit some high points and catch up with y'all next week.
Yeah, so for anyone new, today it's January 5th, so kicking off a new year for 2023. And in this show, we just talk about charts, markets, and kind of how we view it from the professional side as well as some of our own personal trading. So hope you enjoy it and like, subscribe, throw in some comments if you got any with some questions or things you want us to cover. So I'll kick it on over to some of our charts now.
We should probably be doing some predictions for the end of the year in this call. I don't know. It's the first one of 2023. I've written that date more times than I care to count already. I feel like I'm getting old, man.
Yeah, I agree. I think I don't know the number, but I think somewhere in the ballpark of down 10% would be a fair assumption. But I think I'll go back, maybe come back next show with a precise number, but
Yeah,
ballpark, that's where I'm looking.
we normally do for our clients like a prediction deal every year. We give away some prizes. Normally I solicit some predictions in my January market commentary, which I'm going to be sending out maybe tomorrow, probably Monday, and reporting on who won for last year. I won 2 years ago, but I did not win this year. I actually had the market, I think, being up 10% in 2022 was my prediction, if I remember right, and obviously that did not happen. So I'm not sure who won for our clients, who got the prize this year. But I will find out. I will write about it in my upcoming commentary, and we'll start soliciting predictions for year-end 2023 by the time I write and publish my February commentary. So I'll tell you what, though, Kyle. I think that the probability, historical probability anyway, would say that if we have a second consecutive down year in the markets, it should be down more than it was in 2022, because that's how it's worked every single time that you've had multiple down years back to back in the markets. The second year has always, I think always since the beginning of time. Yeah, I might have to check that, but I certainly in recent history, maybe since World War II or I don't know when, but everything I've seen, when you have back-to-back down years, the second year is worse than the first year. Um, so if we're going to be down, I would guess we are down more than 20%, which is what, the S&P was down last year. So that's what I would say is if you're going to go with a down prediction, you might want to turn up the volume on that thing a little bit.
Yeah, and I would have to tend to agree with you. I hadn't put much thought into it leading into this, but what we never saw last year, even though it was a down year, we never saw just absolute, you know, capitulation,
Yeah.
or real sell off anything. It's been pretty, minor really. Just kind of, I've got the chart up here, but
Just a slow grind down, man.
just, yeah, slow grind down. So, but
Lots of bear market rallies. We had what? At least, I mean, one, two, three, multiple month, I think, bear market rallies, that, took the index up anywhere from 17 to say 10%. And each time, I don't know how many times, man, during every one of those bull rallies, or those bear market rallies, um, the bulls like everybody I know who wants to be bullish, who's like a perma bull who thinks stocks always have to go up. They'd be like, "Oh, the bottom's in. Bottom's in. Bear market's over. You got to buy stocks now. You got to buy stocks now." And then, 3 weeks later, they're like, "Oh, I lost money again." We're
yeah,
now lower than where I was pounding the table telling you that the low for the year was. I mean, people, dude, in March, I had buddies who I respect. I mean, they know what they're doing. They're not idiots. But back in March, I had guys telling me that the bottom was in. And oh, Kyle disappeared on us.
I am back.
But I mean, imagine looking at this chart and having like pounded the table thinking that you knew that the bottom was in for the market back in March. I mean, the market did nothing but go down. Like you might have been right for a few days, maybe a week, but ever since March, we're lower. We never even rallied back above that. And so I don't know. You just have to be careful about what you're convinced of and what you're reading in financial media. The Cartoon Network, the guys over at CNBC, I mean, they're from them to Elon Musk and, right on down the line, their job is to sell you stocks. Elon Musk's primary job is not to sell you cars, it's to sell you his stock.
Hmm.
And CNBC is no different. I mean, they put these guys on TV, and you get the New York Times like giving a round of applause to Sam Bankrun fraud, and then giving him a platform and writing about how he's not such a bad guy after all. I mean, like the whole financial media system is just it's obnoxious and disgusting. And that's why you should watch the Elevate chat, because we
Yeah.
just tell you what's up. We just look at the numbers and the charts. Nobody's paying me to say anything good about their stock.
Yeah, and it's always important to look at it without bias. So
Yeah.
the market can go anywhere, but what we want to do is manage risk. And I guess if you want to get into it and just start looking here at the S&P, but we just had a jobs report, which we'll get into a little later, but you just have this consolidation right here. And Shane, it's funny, I was looking at this chart and what's hidden in here is, reverse head and shoulders.
Hmm.
Or I guess it wouldn't be a reverse, just normal. But
Yeah.
you have
Yeah.
here's your shoulder on the left, here's that forming head, and then here we are kind of forming that right shoulder right around the same level as that rally.
Yeah. Which
Tomorrow's
takes
the
you.
non-farm payroll number. I think this you're going to see a pretty good move out of that. It's always a coin flip, but if I had to bet, I'm thinking it takes us lower from there. I mean, you're under the averages, so here's the 50 day. Here's that downtrend resistance line. I think cards are stacked for it to go down, other than, the January effect. So seasonally, kind of start of January usually has a bullish phase. So there's always a
Yeah,
few things to
the
consider.
optimism lasted about 20 minutes on the first day of trading this year, so and then nothing but down after that. So yeah, I
Yeah.
don't know. If that Head and Shoulders turns out to complete itself, I mean, we're going to 34.91, or thereabouts. So
Yep.
that's a bit of a ways down. Yeah, this chart here, it's just such a pretty clean. I don't know. I mean, this is doesn't get much easier than that. No reason to get bullish or too optimistic until you're like, you know, get above 4,100 and then test the 200-day moving average from above and actually hold it. That's when you can start getting bullish, I
Hmm.
think, and maybe aggressively, go find some stocks you like. But you know, we're a ways from that. I don't see that happening, given the economic backdrop and Fed continuing to hike rates and inflation continuing to stay persistently high, and Amazon firing 17% of its workforce last night, which was higher than what they had originally anticipated. Salesforce.com, sent out a 3 o'clock in the morning email saying they were laying people off. I don't know. I can't remember. That was probably 10%. I don't, A lot of people are going to be without jobs here shortly. I would expect that unemployment will go higher, and we will be in a recession before too long. Officially and undeniably, we're probably already in it, but I think that's coming. So this chart to me is just such a great long-term look at where are you? Like when you go to the mall and you're like, you are here. Well, here's where we are. This is where we came from. This is where we're headed. Until something changes, like you can kind of see the path is just grind lower. And in my opinion, that's what we see. And the next, I guess we'll look at the S&P again in a couple of slides, but the next slide just kind of shows a couple of chart patterns that are prevalent in pretty much any chart you want to look at, anything that moves, so not gold. Just kidding. You can find these in gold chart too. You can find them in pretty much any chart because it's a chart. It's kind of how humans behave, right? Like things go up and they go down and they go up. They just consolidate around a level that people think is a fair price, and then they break one way or the other.
Hmm.
And things that are going up tend to consolidate and then go up more. Things that are going down tend to consolidate and then go down more. And it's not 100% thing, right? If trading was a 100% of the time this happens at this line, everybody would do it, and then it wouldn't work anymore, paradoxically, right? So, these Kyle, you got the CMT letters after your name. I don't. So you might have a better explanation than me, but to me, it's just this is what happens more often than not, and it's a probabilities game. Sorry, I'm
Yeah.
getting a delivery from our house right now. By the way, you should check out that stock. That one looks great. It's super bullish. I didn't put a chart in here for it, but it looks good. Anyway, that being said, this is what a pennant looks like, and the S&P 500, if you want to look at the next chart, well, it'll show you that we're on the right hand side of this. We're in a bearish pennant.
Yeah.
It's coming. Hey, we headed down into this pennant, and the probability is such that we will break down out of it. um that's not 100% guarantee, right? A probability is not a guarantee. It's just probably that's what's going to happen. And there are no guarantees in trading. So if you want to take a position, that I would take a position that this thing's going to break lower, um,
And
in the next few days.
something important too about technical analysis is that Shane, you're talking about it breaking down, and there's that chance that it breaks up. But if you go back test and look at the probabilities of it, having a continuation move lower versus higher, you could take that long trade and bet against it failing and risk accordingly based on how often that happens. So, yeah,
So
certainly.
now I disappeared on you. I've been waiting on this delivery. It's been supposed to be here for like a week, so I'm looking forward to it getting here. It's my wife's Christmas present,
Oh,
which,
nice.
by the way, I was not 5 weeks early buying the wrong gift. I got the right one. She likes it. So we're keeping it, and it's going on the wall. It's a picture. But I need to make sure that this delivery shows up. So I might take a brief break, and you'll have to walk people through it on your own for a minute, but it shouldn't take too long if they call
Yeah,
back.
not a problem. So, anyways, that's the big one here is that understanding odds are in favor this breaks down, but it could break up and you could trade either way, but you are going against the trend on that side, and that's a trade. This is just you could take a little piece here, go long, but if you're a long-term investor right now, this is not what you've been waiting for a great signal to get in. So it's still just managing risk.
Yep,
And
I'd bet on a breakdown, but don't have to bet. You don't have you
yeah,
actually That's another good point, which I put in my last market commentary, is like the market's constantly giving you prices and inviting you to do business with him, but you don't always have to do business with Mr. Market. Like you don't have to. You don't have to. I don't have any open positions right now.
hmm
None. Because I'm number one, I'm too busy, but number two, like I don't have high conviction about anything. I think the market's ultimately going lower, but I don't know. It just doesn't even seem worth it to trade it to me right now. I'd rather keep my cash and sell put options, which we actually we'll get to when we look at the Apple chart, because I almost sold some Apple put options today, which is a cool way to make a little bit of money while you're waiting for the market to pick a direction.
yeah. And on this one, so on Qs, I like this chart where you're breaking down and we tried this little rally here and just couldn't really do anything today or yesterday. We had a lower close. Today we're down here. Qs to me looks like we're coming right back down here to retest this 254 level, and I don't think that's the end of it by any means. I think that
Well,
he a little bounce there, and then I think those pre-COVID highs are going to be a pretty quick target to hit.
yeah, that would be my expectation. Um, so we'll have to see how it plays out.
Yeah. So Apple, Shane, you're talking about this, and first things first, we talked about this last time, but we've broke through that key level that was tested so many times at
Hey,
138.
you're on your own for a second. I got to take this call.
All right, I got it. So, 138, that was a very key level. And we tried to come up, retest it a little bit right here, got into maybe 137, broke down since then, now below this level. And, Shane and I, we've talked about this 100 price gap down here, which would be a great place to be getting Apple. So, Shane will talk about it,
There
but
you go. I'm back.
okay. So, Shane, I was just going to get into the basics of when you sell a put. And the idea is you sell a strike down here, you collect that premium, and if the share price never gets down here, great, you just keep that premium and you've netted some money. Now,
Yep.
if the share price does get down here before those options expire, you're now committed to buy Apple at $100 if that's your strike. So here you are, you collected a premium on the way down, it got where you love it, and now you have to buy it at the price you love. So that can
Yep.
be a strategy that is a nice way to, take advantage of a market where you just decide, hey, I don't want to take an active position or play it, but what I do know is I'd love to get in here. How can I earn a little bit while I wait?
Yeah, if Apple was trading at $100 today, would you buy it? That's the question. If the answer is yes, why not get paid to wait for it to get to the price that you are wanting to buy it at anyways? So right now you can go sell what was it? It wasn't February option. Was it February? Let's see. It was I like to only sell options within like 60, maybe 70 days to expiration because the time value starts to exponentially deplete during those final 60 days. So the March 17th $100 Apple call was a dollar and 37 cents. And so you could just put a dollar and 37 cents, which times 100 shares is 137 bucks in your pocket. And all you got to do is have 10 grand available in your account to be willing to purchase the 100 shares of Apple if it were actually to go down to 100. Now, $137 may not seem like a lot of money, but 137, right? $137 divided by a $10,000 obligation is 1.37%, right? But here's the thing, is I only have to have that position open for 71 days till March 17th. So if you take 365 days a year divided by 71 days, you could make that 1.37%, 5.14 times. You could do that trade 5 times a year, basically. So 1.37% times 5.14 times per year is an annualized yield of 7%. So basically, I could get paid 7% a year to agree to do something that I would gladly do for free. I would,
Hmm.
if Apple was $100, I would do it for free. Nobody would have to pay me to buy it for $100. I would just buy it. But instead, I can name my price right now and say, hey, if Apple trades at $100 or less between now and March 17th, I'm buying it. I'm totally willing to buy it. And by selling that $100 strike put, I'm obligated to buy it. If the owner of that put option wants to sell me the shares at 100, I'm obligated to do it. So the key to this is, well, there's a few keys. Number one, only do it on stocks. Like only sell an option if you would be happy to see it get executed. And that's for calls and puts. If you're selling a covered call, don't sell a covered call that you wouldn't be happy to have executed. Same thing with this put. Don't sell $100 put if you would be pissed off about buying Apple at 100. And how would that happen? Well, if Apple drops to $50 a share between now and March, and you have to pay 100 for it, you might not be real happy about that. Um, but I don't think that's a very high probability thing to have happen. So especially in the next 70 days, right? Apple's already down 30% from its highs. Like it would have to go down another, what, 60, 70% to get to 50. So anyway, it's probably not even going to get to 100 is the point. But if it did, I'd be glad to have that option be exercised on me and have somebody force me to buy at $100. So only sell options that you would be happy to see exercised, which basically means only do this put option strategy on forever type stocks, like stocks that once you buy at a good price, you will put them in the forever account and never trade them again. Just leave them alone, hold them forever, give them to your grandkids. That's the kind of stock you're looking for. You want to do it when it's already down big. You want to sell way out of the money put option that's unlikely to ever be in the money. Um, and what else? I guess those are
I,
those are the real. Oh, and make sure you have the cash to buy it. Don't because like here's the deal. If I sell the $100 put option, my broker is only going to force me to have 20% of that 10 grand that I need. So if somebody forces me to buy the 100 shares at $100, I need 10 grand. If I only have 2 grand, I'm in trouble. I could be bankrupt, right? If I don't have the money to actually buy those shares, now I'm calling Kyle and saying, dude, I need to borrow 8 grand to, meet my commitment or I'm going to be bankrupt. Or I've got to, sell a car or sell something in order to pay. Like you don't want to get into that situation. So you only want to do this against cash that would otherwise be sitting around earning less than say 7%. My cash is earning nothing. It's not like the bank's paying anything on cash. You got to buy a US Treasury to get any type of yield or something like that, right? So This only do this on cash that you have that's otherwise not earning very much. And 7% a year is a pretty awesome return just to agree to do something you would be willing to do for free.
Hmm.
Anyway, sorry, that took a little longer than I probably expected it to, but I think that's if I had to stick to only one trading strategy for the rest of my life, that'd be the one. That'd be the one. I mean, I've done this thousands of times in my career, and I think I've only been forced to buy stock one time, only once. And I was
Yeah.
happy to do it. It was Johnson and Johnson, and I ended up selling it for a profit later. So, um, it works so well. It's such a high percentage trade.
It does. So thanks for sharing that. And those are just little tidbits to try to throw in here on just how to execute a strategy and different tools to use. One strategy is not the proven way to go. You can always kind of pick what works best for you and your goals, but there's a few things out there for sure. So
By the way, Apple looks terrible. I would expect it maybe to get a little bounce because it's a little oversold right now, but it looks absolutely awful.
yeah,
And I will not be surprised if it grinds its way down to 100 during this year.
yeah, grind or this is
Oh,
the big comparison. We talked about this before, but Tesla looks a lot like Apple did up here. So
yeah. And it's not
look,
grinding lower anymore. It is
no.
sinking.
So Tesla right here just started breaking really hard and was at the span of maybe 2 weeks, lost, gosh, almost half its value right there. So it's down here.
It's a
There's
disaster.
no way I'm buying this right here. If it holds 100, like really holds it, consolidates a little, yeah, I think it starts to look good, but I really need to see that happen because what I think happens is it just bounces around a little here and then breaks even lower and just scares the heck out of a lot of people.
Dude, it's down 73% from 414. 73%. How much is it? It's got to go up 300% or so to get back to even. What's the
Gosh,
point of picking the bottom here? You don't have to pick
yeah.
the bottom. You don't need to get stinky fingers. Like, how many bottoms have you seen? There was a bottom at 207, then there was another bottom at 207, then there was a bottom at 179. Now, all the Tesla fans are going to be calling the bottom at 109. It's not going lower than 104.50. This
Yeah.
is the bottom. You got to buy now. It's like, uh-huh. That's what you said 2 weeks ago at 200.
Yeah, and if you want to go see what's possible, I encourage you go look at we're just looking at Roku as a chart. Zoom, Peloton, General Electric. I
Oh
mean,
yeah.
some stocks they get way ahead of themselves and they can pull back like this, and this might not come back to those highs for 20 years or never. I mean,
Or
who
ever, yeah.
knows?
Cisco
So
is the famous one that never got back to 80 after the dot-com bubble burst, right? Cisco's a great company, but it's 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 now 2023 and it's still never seen that price since ever.
yeah. So there's no way. I mean, I have zero interest in picking a bottom on this one. I would much prefer to go find something that looks like Tesla did right here, where it coils, consolidates above your averages, and off we go.
Yeah.
Something like this, it's just I'm looking for shorts at best, but I'd probably just leave this thing alone. It
Yeah.
looks absolutely terrible.
Grab some popcorn and head to the sidelines. This is going to be a disaster.
Yep.
I mean, it already is, but yeah, I mean, hey, what's something that's down? What do you call something that's down 90%?
Something that can still go down 90%.
Well, that and it's something that was down 80% and then went down 50% again to be down 90, right? That's how you
Yeah.
get to be down 90 is first you're down 80 and then you lose half of your money again to be down 90%. So, I mean, think about it. This thing's down 70% now. In order to be down 80%, it's going to need to lose 40% or so. I mean, there's this, oh my goodness. You can always lose 100% though. So there's still 100% of your money to be made short this thing, just so
Yeah.
you know. Anyway, all right.
So
On to the next.
on to the next, crude oil. So the new year started and crude oil just took one big sell off again.
Yeah, at least it finished the year last year with a slight gain. For there was a moment in time where it was actually crude oil was down for the year, and everybody knows what's going on with gas prices. So just to me, like that juxtaposition between crude oil was essentially flat for the year 2021, was actually down for a little while. In early December, was down for the year 2021. Yet we've all been to the gas station and we know that gas prices were not down for the year. They were, gas prices didn't finish the year as high as they were in the middle of the year, so that's cool. Um, but yeah, I think it's interesting. Like, I don't know. To me, and maybe I'm the only one, which is fine. I'm the only one on a lot of things, but to me, it blows my mind that oil was like essentially flat for the year, and as of today's trading, it is down from year end 2021. So yeah, I just wouldn't expect that to be the case, just given
Hmm.
what I know about inflation and prices. And so it can't be oil that's driving the current inflation over the past year. Oil is flat. Inflation is 7% plus, right? So I don't know. I find that fascinating.
Yeah. And what's fascinating, and I think a really good point to bring up is crude oil this entire time, the narrative, if you were out there looking for what every expert was saying, bullish oil. Oil's going to 200 plus, and Joe Biden's to blame, right? We're closing everything down.
Oh yeah.
And if you just traded price action, you caught on to this kind of short position moving in. And that's one thing you always got to remember, any stock or anything tradable is that you can hear a lot of news out there and it gets real confusing,
Oh yeah.
but you
And
just watch.
the bulls are the loudest at the top.
Yep.
That's when they're you can't, you gotta be long oil, that's what they were saying in March, early March. Like everybody's got to buy oil, buy oil, buy oil. Um, they were the loudest back then. I do think that there's a limit. I've said it on this call several times recently, but if the government was being honest, which is a total wild card, who knows? Probably not, maybe. Um, they are seeking to replenish the strategic oil reserves at this $70 level, 68 to $70, and everybody knows that. So I kind of think there's a bit of a put on the price of oil because they really do need to replenish that strategic
Yep.
reserve. Um, and I think $70 a barrel is probably a fair price to do it. It's down nearly 50% from the highs back in March.
Hmm.
Um, so yeah, I do think I wouldn't want to short. I mean, as bearish as this looks, I probably would not. I mean, and I don't short oil. I don't trade oil, but I wouldn't short this year just because of that fundamental driver. The technicals look awful though.
Yeah. And that's one of those things people need to always remember is stocks and commodities are very different. Commodities, oil unlikely will hold a position below zero, as we saw. I did hit there, but there's always a store of value in commodities. People always need to fill up the car, buy some wheat to make cereal, stuff like that. So,
Right.
um, I don't know. I think around here could be a good spot where they start buying it up, but I don't have any interest in trading this. It's kind of lost its luster for me because now shorting it here feels like a bad bet against the fundamentals, and going long into a recession doesn't sound great either. So,
Yeah, if it just needs I mean, it could hold between 77 and 70 in that 10% range for the next 6 months.
mhm.
Then you're prepped for a move, either up or down,
Yep,
one way or the other. It's going to break, but it needs to go sideways for a while. And the
yep,
longer it goes sideways, the bigger the break's going to be when it finally springs out. So, yeah, ideally you just see it hang. And that hopefully will help inflation come down for everybody and like the real economy because um, I know people are, I don't know, it's just hard out there, man. I feel bad for like how expensive some things are, and some people just don't make enough money to keep up, and it's
yep.
sad.
I agree with that. So, next thing here is our best indicator of a recession, and that is an inverted yield curve. At least we finally took a bounce or two, so it doesn't feel like a horror movie. But
Yeah,
I
but
mean,
that's a pretty
it's
steep
terrible.
drop. Yeah, the
Yeah.
next chart I put in here, I think it's in the next position. Yeah, this is a zoomed in look at just the most recent drop. I mean, that bounce that you're talking about, at least it bounced a little bit, is the bounce you see into this purple line, and it already said no, thank you. Just kidding. I'm not done inverting and staying negative yet. So the longer this stays negative and the deeper negative it goes, likely the worse the recession is going to be when it's finally declared. And this to me, I mean, if this is all you had to look at, and I took the name of the underlying off of this chart, you would not be you would not be saying this is going up.
No.
It looks like it's just gonna keep going down.
Yep.
So,
And just it's
not
not a
good.
good environment. And that's the thing people need to remember is that you can look at your portfolio each day and see, oh, the market's up, the market's down. Should I get excited? You got to zoom out and look at the big picture here. We're in a bear market. We're in a downtrend in the stocks. Yield curve is not doing anyone any service. It's it's
The
not
odds are
good.
just not in your favor. They're not in
No.
your favor to be aggressively long. Do you want to have some longs? Absolutely. Like we looked at last week, Hershey and General Dynamics and Novo Nordisk, some healthcare stocks that like there's some things, there's pockets of things that work great in this environment, but it ain't tech stocks. It is not profitless growth. It is not any company that needs to borrow money to continue paying employees or growing their revenue. That's not the stuff and that's not the stuff you want to be long. And that's the stuff people, newer investors, people who came into the market during the GameStop and AMC mania of 2021 with all the helicopter money from the Fed and uh, abnormally, and artificially low interest rates, like that time is gone. Will it
Yeah.
come back someday? Sure, but that environment is over, and the stuff that worked then is not going to work now, and it's not just about picking the bottom and it'll all come back. Like this is a whole different world now.
Yep. And there's no reason to try to be the smart guy. Just play, wait for it to break and things to look rosy again. And
Yeah,
here's the one, Shane, you and I were talking about this. So the US dollar,
breaking
before
out.
you're talking about a consolidation here, maybe it could lift off. Here it's lifting off and just coming into this call, I was looking at some of the currencies that's up against. So British pound, the euro, Aussie dollar, um, and
Japan.
they're confirming this. Yeah, Japan. So, those other currencies weaken, US dollar gets strong, and we've said it before, but a strong US dollar is not good for stocks.
Yeah, and I hope this doesn't just race right back higher. I think to break out of this current downtrend, which we're doing, rally up to the 200-day moving average, consolidate a bit, like do the pennant that we looked at in the second slide, except for the
Hmm.
the bullish version of the pennant, right? Consolidate around that 200-day moving average. You see the 50-day moving average, which is the red line, kind of coming down to meet that 200-day moving average right now. Those will probably cross even if the dollar goes higher from here, as long as it's slowly, those will probably still cross. But the whole point, and I mentioned this on the last call, is like when you see those moving averages consolidate, they're not going to stay tight to one another for very long. They're gonna break away from each other once again, in one way or the other. I think the dollar is probably going to end up going higher. But I'd like to see it kind of take its time doing that. Let that red line and that blue line just kind of stay tight to one another for a little while, maybe a couple months even, and then break out or down as the case may be from there. So um, I think it needs a little bit more time, but this is constructive for anybody who's bullish the dollar, which I will add, as the dollar goes up, the stocks market's going to go down. So this is not good for stocks. It's good for our country. A strong dollar is a good thing for our country overall. A strong dollar will bring down inflation in the long run. Um, Interest rates will continue to rise. Like it's good for the economy, but it's also painful for people who are long the stock market. Um, I think it's better for people, for regular people who are just struggling to get by. A strong dollar is going to be good for them. So bad for the stock market, good for humanity. I'll take a strong dollar all day, but be good if it went at a measured pace instead of a rocket ship back to 114.
Yep. And then Shane, here's our update, and I'm excited to see what 2023 looks like on this one. I don't have any big predictions, but what I can tell you is bonds. I think this is the most obvious short on bonds that I've seen.
Yeah.
I don't want to own them, and we'll see about stocks, but we're both talking about that going down. So this number here, it's going to reset now that we're in a new year, but I anticipate this number getting wrecked again,
Here's
but
what
we'll
I
see.
think. I think that for as long as the Fed is raising rates, for as long as they're tightening monetary policy through quantitative tightening, and taking dollars out of circulation, for as long as that's the case, I expect bonds and stocks and bonds to be highly correlated.
Yep.
So if stocks go up, bonds will probably go up. If stocks go down, bonds will probably go down. I expect them to remain highly correlated, which means you get no diversification benefit in a 60% stock and 40% bond portfolio. You might as well just put all of your money in one or the other because bonds probably will go down less than stocks, but they didn't last year. So, like LQD was down more, right? We see this blue line down more than the orange line. So that's not always going to hold true.
Hmm.
But because that already happened last year, I would handicap it a little differently for the coming year, meaning that bonds have probably gone down a large chunk of what they will ultimately be down. And stocks, I think, have kind of only gotten started. So, from a certain perspective, if you're going to put all of your money into one or the other, you might choose bonds if you're worried about the downside. On the other hand, if you're going to put all of your money into one or the other, either stocks or bonds, you might be focused on the upside. And of course, if stocks and bonds go up, stocks are going to go up more than the bonds are. So if you're focused on the upside, then you should put all your money into stocks and forget the bonds.
Yeah.
But one thing you shouldn't do is put some of your money in each, thinking that one is going to move differently than the other. They're going to move the same way at the same times. And uh, when the Fed stops hiking, or if they stop, if they start easing again, maybe buying bonds, then what I said is not going to work anymore.
Hmm. And then one thing I just want to make sure people know is when we look at this, the bond portion, there's kind of two different camps for that. There's you're in the wealth accumulation phase and you're using bonds to diversify. That's where this portfolio gets clobbered. Whereas if you invest in shorter term bonds, those are actually yielding a pretty nice return right now and takes away some of that risk, but it's used as a cash flow tool, not a diversification tool.
Well, and the other big thing, Kyle, is like if you're retired and you're using bonds for income purposes, don't use a fund. Do not put your money into a bond fund, right? Because this LQD, for example, is a corporate bond fund, investment grade corporate bonds. But they create shares and cancel shares based on money flows into and out of the fund, which means that if that fund gets a big request for cash from its investors on a given day, it's forced to go out and sell its bond holdings regardless of what the price is because they have a limited amount of time to satisfy that investor's request for redemption. But if you buy your own individual bond that has a short-term maturity in nature and it's to a highly rated company, if you need cash, you're not going to go sell that bond. You're going to go sell something else, right? So if you can hold the bond to maturity and just continue collecting coupons, as long as the company doesn't go bankrupt, you're not going to lose any money on your bond.
Hmm.
Now, can companies go bankrupt? Sure. I mean, it happens. So that's why you got to do a little bit of analysis to understand who you're lending money to, and do you have the confidence that you can hold that bond to maturity. But in a bond fund, none of it works that way. If enough investors ask for redemptions, the bond could be forced to liquidate bonds that it can't sell at any price because the bond market doesn't trade like the stock market. You can't just go and click buttons and buy bonds all day. Like you gotta pick up the phone and call somebody and find a buyer, especially when it's a big enough trade, right? So you got to be careful in bond funds. You never want to buy a bond fund, in my opinion. If you want to be invested in bonds, the best thing to do is buy the bonds yourself, do your own homework. And I guess I would caveat that slightly by saying if you're in a treasury bond, like a bond fund that specifically only holds, or to a large extent holds, United States Treasury bonds, whether long term or short term, that's super duper liquid and it's easy to buy and sell. So those ones I don't worry about as much. But in the corporate market, I mean, there's only so many bonds out there and so many buyers and sellers. So you can get into a situation where there's like perceived liquidity where there really is none.
Yep.
And bond funds have failed because of this. So the most recent one I remember was like I think it was called the Third Avenue Junk Bond. I mean, they just one day they put a note up on their website and said, "We're no longer honoring redemptions. We're going to try and liquidate the fund as fast as possible and return as much capital as we can." And that was it. Fund was done just because they got too many redemption requests and there was no market for the bonds they were holding.
Yep. So, a few different tools out there, but it's always good to understand some of these dynamics so that you match your objective with the tools that are available.
Oh, and I would stay really far away from anything that calls itself a high yield bond. That's a junk bond. And I seriously think we're headed for some type of major credit event
Yep.
in the next 12 months. And I would not want to be anywhere near junk bonds.
Absolutely not. I agree with you there. So, um, you know, bond related, but now we're talking mortgages. Shane, here we are. So a 30-year now 6.5% or 6.48%. A little better, 5.73 on the 15-year, but it's still not doing any favors for the housing market. And I think I'd want to wait right now to really be out there buying.
Yeah, it's not, I mean, it's not over 7%. So that's good. I'm feeling we're going back over seven. I don't know when. I don't know how long it might take to get back over 7%, but I don't know. Fed probably going to hike rates on what, February 1st is the next time
Hmm.
that they meet, and I do not expect them to cut rates at all in 2023. The only way the Fed's going to cut rates in 2023 is if the market absolutely crashes from where it already is. It's going to need to go way lower, and the economy is going to need to take a real big dump in order to get the Fed to do anything like cut interest rates,
Yeah.
reduce interest rates. So I would not plan on that happening. If you're in the market for a mortgage right now, I wouldn't be real excited to go get one, but I also wouldn't be surprised if you wait 6 weeks or 6 months and you end up paying 7%. So it's kind of, I don't know how much lower they can go from here. I also don't know how much higher, but I will not be surprised to see them back at seven.
Yeah. And something I just want to bring up is, you know, too many people are talking about this Fed pivot idea. And I will tell you, whenever narratives get out there, if you use that to trade on, you're following the wrong trail.
Yeah.
You got to figure there's people that pay a lot of money to get the great information. Um, Most people don't have that. And even we don't always have access to it. We don't pay somebody to do nothing other than dig and find things. And so when you hear narratives, it's just go look at the price action, go off that, manage your risk, and
Yeah.
see
Well,
what
even
unfolds. But
yesterday when the Fed minutes came out, which we already know. I've been writing about it for months. We've been talking about it in the Elevate chat for months. The Fed minutes came out from their meeting like what, 6 weeks ago now? No, I guess 4 weeks ago now. Maybe I don't even know. But some time ago, we already knew there was already a press conference. They already said we're not going to cut rates. And when the minutes came out yesterday, all it did was confirm all the things we already know that they're not going to cut rates. And the market promptly dropped 1.2% in the next 30 minutes
yeah,
just because the minutes came out. And once again, for like the hundredth time in the past 6 months, everybody who's praying and begging the Fed to pivot to cutting rates got even more data like, no, we're not doing that. No, we're not doing like they're it's not happening. There's no cut coming, and it's so obnoxious that people will not let it go. I can't understand it.
yeah. So that's people need to know that is there's the buy the rumor, sell the news. It's pretty actually a good saying to go by, but just trade the price action and never bet on some event happening unless you happen to be the only person that knows about it. But then you're talking about inside information, and usually that gives you the Crossbar Hotel as a permanent place to stay. So
Yeah.
you want to stay
I
out of
mean,
that.
and the only thing I'll say to like kind of, you got to do, you can't be so convinced of everything. I mean, I'm convinced that they're not going to cut rates. I'm absolutely convinced. The wild card is that this is me trusting the very same people who told us, all of 2021 that inflation was transitory and it wasn't going to be a problem, right? So they could be wrong and they could be lying. Like those are when you're dealing with the government, that those are two things that are always real possibilities. But if you take them at their word and you see the same economy that they do, they're focused on regular people paying obnoxious prices for eggs if they can even find the eggs. That's what they're focused on. They don't care about the stock market right now. Apple goes
Nope.
to 100. Who, so do you think Elon Musk and Jeff Bezos care what the price of eggs is? Ah, they don't care. They're buying rocket fuel and stuff, dude. They don't care about eggs. I mean, and so, for better or worse, it seems like the Fed's paying attention finally to the fact that regular people are struggling and they're trying to do something about it, which is going to be painful all around.
Hmm.
But yeah, that's the wild card. I don't see them cutting rates, but if they're wrong, like they were about inflation being transitory, or if the market absolutely just gets killed, they'll end up cutting rates.
Yep. So
So,
we'll see how it plays out. But yeah, this number that came out this morning isn't helping anybody. So
oh,
came in and those, job cuts, they've not fed through the data yet. And the Fed has one goal right now, fight inflation, and they're going to do that by getting unemployment up. And
well,
it's not really
I'd
feeding through.
I guess I'd say that it did help these 235,000 people. You said it's not
Right.
helping anybody. It
Or
it helped
yeah,
it helped these 235,000 people who are looking for a job.
yeah. Speaking to investors on that one, but yeah,
Yeah.
these are people trying to get jobs, and unfortunately, the goal, because the Fed really can only impact demand, is bring unemployment up and jobs down. And here we are with jobs coming up. So we have the non-farm payrolls number coming out tomorrow. I haven't looked at the estimates on that one. Key thing there is wouldn't be surprised if this kind of fed through. Still not seeing the softness in the labor market. And I think no matter what the number is, it's the catalyst that's going to push us out of that consolidation. And I would bet lower, but we'll see.
Yeah, I mean, look, this is good news. It's great that 235,000 people that didn't have a job before now have a job and they can, pay for eggs and they can pay for gas and maybe buy a car. It's great. It's great news. Uh, the problem for the stock market and the reason that the market is down, another 1.25% today, Nasdaq's down 1.6 as we're talking. The reason the market is down on this news right here, this good news about 235,000 jobs, is that this gives the Fed permission to keep hiking rates. This is one more nail in the coffin of the idiots running around begging for a rate cut. Like the
Hmm.
Fed's not going to cut. This would have to be a negative number. Do you see any negative numbers on the chart? There's no negative numbers. Like we need to create negative jobs, which of course would be bad news, right, for the actual economy. But for the market, they would see that as, oh, we didn't create any jobs this month, that maybe the Fed will back off raising interest rates now. But as long as the market is continuing to add hundreds of thousands of new jobs every single month, the Fed says, "Cool, we can keep hiking. We're not hurting anybody that bad. I mean, if they're still creating new positions and hiring people, let's keep doing what we're doing and try and bring inflation down. Because if we don't, these new $235,000 or 235,000 people with new jobs and new paychecks are going to go out and spend that money, causing prices to go higher." So this is great news, but it is permission for the Fed to keep hiking rates, which turns into bad news for the price of stocks and lots of other things. So
Yep.
that's how you read this. And until that number is zero or negative, the Fed's just going to keep tightening the screws.
Yep. So not a great thing. And then Shane, you brought this in, and this is something. So always looking at the options market. So the option market is pretty forward looking. People pay a lot of money for downside protection, and you can use that sometimes as an indicator. And Shane, looks like you've pointed this one out. So what are you thinking there?
Well, I don't think much of anything. I wouldn't make a lot of trades just based on this alone. But you can see that the last time, the blue line got above that black line, it coincided with a bottom in the S&P 500 that was back during COVID. So this is the blue line is just the small traders, so people who are trading less than 10 option contracts. They spent more than 30% of their money buying put options, which is abnormal. Usually the small traders are just perma bulls. They're always buying calls. They always think the market's going to go up for some reason. They always have some narrative of why the market's going to go higher. And a lot of times it does. But when they buy when they spend this much of their money buying puts, either speculative or protective put options, they're usually wrong. That's pretty much what it boils down to. Um, the truth is if you look a little bit more deeply into these numbers, is that these events don't necessarily coincide with the absolute bottoms. They're kind of like shorter term turning points where essentially the long-term return from here is probably going to be better than the short-term return. So the market could keep falling in the short run, but say a year from now, 2 years from now, 3 years from now, it probably is. it's probable that the market will be higher than where it is today. And so I thought it was interesting. I mean, we're Kyle and I are pretty bearish, so I'm looking for anything I can put in here that would be in the bullish camp. And so, this is something that people look at when options traders get this pessimistic, there's usually some type of bounce coming. Um, I don't know if I see that this time. I really am concerned about the situation we're in right now. And so, I'm not sure I'd put a lot into this, but just something to keep an eye on.
Yep. And then the last one, a little lighthearted stuff, but eight most shocking tax deductions that Trump had taken. So I thought this was pretty good. So he claimed 328 million people as dependents. So hey,
Technically
pretty,
true.
yeah. So, nothing, no wrongdoing there. But yeah, I don't know, Shane, if you had a chance to look at it, but just good tax humor and financially related
Is
because, 2023 has now begun and people are thinking about last year's taxes. So perhaps there's some good strategies you can pull out of this.
This is pretty hilarious. I hadn't actually seen this yet, so I'm just reading them for the first time. It's these guys are so funny. I mean, the way that they write, it's just like if you imagine Trump speaking some of this stuff, like he always throws in that one word at the end, suspicious. Number four, Melania's returns filed individually. It's just yeah, it's super funny. And I'll never miss an opportunity to pick on a politician. So
Nope.
from either side of the aisle. Those idiots can't even pick a speaker now, right? They're like on day four of fighting about, and that's what you can expect probably for the next 2 years, by the way.
Yeah.
They got effectively a lame duck president, a very old lame duck, I might add. And they're just gonna fight and argue. I love to see Pelosi gone. That's great. Bye bye Pelosi. I could do without her. Um, but whoever gets the Speaker of the House job next is probably going to be much better. Just be a different person doing the same crap. I don't know. I don't have a lot of room for politicians, man. Career politicians shouldn't be a job possibility in this country. It should be service and for a limited time only. I don't like the idea of being a politician as a career choice. I think it's ridiculous.
Yep. So awesome. Well, Shane, thanks again for your time and looking forward to a new year here. So let's see
Yeah, we went over,
what's
but that
ahead.
was good content today. Good stuff. Thanks for the conversation, Kyle.
Yeah, you're welcome. Have a good one.
All right, later, buddy.